Gold performed one of the biggest weekly drops in the previous week, displaying traders' eagerness to get to cash as the fundamentals of the global economy, and especially in the US, continue to change rapidly. The movement in the previous week seems to act as a wake-up call for the gold market and could be a signal for further increased volatility. This report will be looking into some of the latest and most relevant topics related to gold, as well as incoming economic data releases that can move gold's price accordingly. We will be ending this report with a technical analysis for the yellow metal, where trends and important levels will be identified. First, we would like to focus on the reasons behind the recent sell-off performed, as the magnitude of the price movement is definitely not by chance. On the 16th of June, traders focused on the FOMC interest rate decision, its accompanying statement, future projections, and Chairman Jay Powell's press conference. This is an event that was expected to create substantial volatility, as we noted in our previous report. Some of the comments written in the report may have grabbed the attention of gold traders, as they may have cleared some subjects that were blurred previously. First, it was confirmed that the ongoing vaccination in the US has reduced the spread of the virus. The sectors that have been heavily impacted by the pandemic are still weak, yet some improvement has been observed, which could be preparing the ground for a decisive rebound. However, one of the most impactful outcomes of the meeting were the summary of economic projections. This report pointed that the Fed could be in for an interest rate decision sooner than initially forecasted. This scenario was not priced in by the market and may have created notable volatility turbulence that was observed very clearly in the FX market, as the US dollar pushed higher to levels seen previously in April, putting an end to the continuous downfall of the currency. Furthermore, the market had taken note of Jerome Powell's reluctance to overrule chances for a QE program tapering. This could be an early sign that bond yields could be heading upwards and that economic risk in the short term could rise. Bond yields and gold have a very strong correlation between them that could be characterized by an adverse relationship. Thus, if the Fed is willing to reduce its QE program, which could be supported by a positive outlook of the economy, then bond yields could be on the rise, forcing gold to drop substantially. These views are our personal ideas and could differ from trader to trader, thus caution is advised. In the following days, an interesting economic calendar is to unfold that could keep gold traders at the edge of their seat, as the effect from last week's events is slowly wearing off. On the 23rd of June, we get the preliminary US manufacturing and services PMIs for June, along with the US new home sales units for May. On the 24th, we get the final US GDP reading for quarter 1 and the weekly initial jobless claims figure. Last but not least, on the 25th, we get the US consumption adjusted figure for May and the final University of Michigan sentiment for June. Finally, on the 29th of June, we get the US consumer confidence for June, which is rather important. Moving now to our technical analysis, this is gold's 4-hour chart. After the strong sell-off, the gold market had landed and bounced off our current S1 1765 line, forming our first support level. Interesting for the sellers could be the lower level beneath the S1, which is the S2 1730 hurdle, which was last tested in the first part of April and paved the way for higher grounds. In a more extensive selling scenario, the gold market could also drop to the S3 1680, which could be considered as a 3-month low. For the time being, with the market overcoming the bearish momentum and seemingly the bulls taking control, we could see a trace back to the R1 1810 resistance, which if reached could be a motivation for higher grounds like the R2 1860, which in our opinion could be a considerable challenge for the buyers. Finally, the R3 1900 round number level is a peak line reached in the past months. Thus, we could suggest it is a very recognized level for the market. Below our chart, the RSI indicator seems to be gradually lifting off the 30 line, implying some selling orders may be closed. Thank you very much for your time and focus. We appreciate your participation. And if you like this video, please feel free to share and subscribe. Please note, as an effort to support traders on as many fronts as possible, We are now presenting live weekly webinars on trending subjects, and all our subscribers are welcome to participate. From everyone here at IronFX, wishes for solid trading.